Welcome to TalkTickers. We're your shortcut for getting up to speed on important earnings calls. Today, we're jumping right into the first quarter 2025 results for Bread Financial. That's ticker BHF. Our goal here is simple. Give you the essential insights, the key takeaways from their calls so you're informed without spending hours listening yourself.
Absolutely. So kicking things off with the headline numbers for Q1 2025, Bread Financial reported $138 million in net income. That works out to 2.78 cents per diluted share.
Okay, $2.78. And any big balance sheet moves?
Yeah, a couple of significant ones, actually.
Yeah.
They issued $400 million in subordinated notes. That boosted their total risk-based capital ratio by over 200 basis points.
Yeah,
quite a jump.
A big boost. And wasn't there a share buyback, too?
There was. They completed a $150 million share repurchase program, picked up about 3.2 million shares, and interestingly, they did it at roughly 5% below tangible book value.
Buying below book. We'll come back to that. What about deposits and sales?
Good question. Their direct-to-consumer deposits, they're still growing strongly, reached $7.9 billion. That's up 13% from last year. So that strategy seems to be working.
13%, okay. And credit sales?
A bit more modest there. Credit sales saw a 1% increase year over year, landing at $6.1 billion.
Got it. And what about credit quality, loss rates, reserves?
Actually, some improvement there. The net loss rate came down to 8.2%. That's 30 basis points better than a year ago. The reserve rate also saw a slight improvement year over year, sitting at 12.2%.
And I saw something about the type of customer changing, more prime borrowers.
Yeah, that was interesting. The percentage of their cardholders with prime FICO scores, 660 plus, that increased to 57%. That's up 100 basis points, a full percentage point from last year.
Okay, so potentially shifting towards slightly less risky customers. Let's dig into that balance sheet stuff a bit more, that $400 million in notes. Why was that so significant?
Well, basically, it adds to their Tier 2 capital. Think of it as a secondary cushion against losses. Boosting the total risk-based capital ratio by that much, over 200 basis points, really strengthens their ability to handle, unexpected financial hits. Management also pointed out it was good timing, tapping into strong debt markets.
Right, taking advantage of conditions. And the share buyback you mentioned, $150 million below tangible book. What's that telling us?
It generally signals that management thinks their stock is undervalued by the market. Tangible book value is like the net worth of the company minus intangibles. Buying below that suggests they see it as a good investment for the company's own money. It also returns capital to shareholders, which investors usually like to see.
Makes sense. Okay, and those direct-to-consumer deposits hitting $7.9 billion, now 43% of their funding mix, up from 36%. Why is that shift important?
It's pretty strategic. These direct deposits tend to be stickier, more stable funding than relying heavily on wholesale markets.
Yeah.
It gives them more flexibility and potentially lower funding costs over time, less reliance on, the whims of the market.
And liquidity seems solid too, $7.4 billion available.
Exactly. $7.4 billion in liquid assets and undrawn credit lines. That's about a third of their total assets. It's a really strong buffer, gives them a lot of flexibility.
And capital ratios are getting close to their targets.
Yeah, CET1 and Tier 1 are at 12.0%, total risk-based at 15.5%. They mentioned the final CECL phase-in hit this quarter. That's the accounting standard for credit losses. It had a one-time impact, but that adjustment is now fully done.
Okay, so that's behind them. And overall, loss absorption capacity looks strong at over 25% of loans.
Right, a solid cushion there.
Let's pivot to credit performance then. We saw the net loss rate and delinquencies improve. What's behind that good news?
It seems to be the payoff from credit tightening actions they've been taking over the last few years. They specifically mentioned seeing better trends in what they call late-stage roll rates.
Meaning fewer delinquent accounts are actually turning into charge-off.
Exactly. Suggests their underwriting and collection strategies are, having the intended effect.
But despite those positive signs, management sounded pretty cautious, mentioning macroeconomic uncertainty, tariffs, inflation worries. Why the caution now?
Well, while the current credit picture looks better, the future is pretty uncertain, isn't it? Yeah. Potential tariffs could squeeze consumers and businesses. Inflation is still a factor. And importantly, they're expecting the Fed to cut rates multiple times later in 2025.
Rate cuts. Usually good news, no.
Eventually, maybe. But in the short term, for a company like Bread Financial, it can actually pressure their net interest margin. They seem slightly more sensitive to asset yields falling faster than their funding costs adjusting downwards, at least initially.
Okay, so that explains the cautious tone. And their outlook reflects that too. expecting loans to be flat to slightly down for the year.
That's right. Partly the economy, partly their own strategic credit tightening. But they do expect total revenue to be flat to maybe slightly up, even with that loan guidance factored in.
And the net loss rate outlook for the full year is still in that 8.0% to 8.2% range.
Yeah, pretty much holding the line there. They did flag that Q2 might be a bit elevated due to some lingering effects from hurricane relief actions they took late last year.
Okay. And reserves staying stable, too.
Relatively stable, yes.
Yeah.
It looks like they're balancing the better credit quality they're seeing right now against, well, all that macroeconomic uncertainty we just talked about. They said they're keeping a prudent, sort of cautious weighting on adverse economic scenarios in their models.
Right. Playing it safe. Let's talk strategy. New partnerships. That Crypto.com card sounds different.
It definitely is. Offering rewards in crypto. It's certainly an attempt to reach maybe a younger, more tech-focused audience. Could be interesting, but obviously comes with its own set of, volatilities and regulatory questions.
True. But they also expanded with AAA and renewed with Academy Sports. Those seem more traditional.
Yeah, absolutely. Leveraging big established member and customer bases there, the AAA deal lets them market deposits and loans across North America. Renewing with Academy Sports shows that core co-brand partnership is working well. They also mentioned having a robust pipeline for new deals across different areas.
Okay, keeping options open. What about the regulatory stuff? The CFCB late fee rule getting vacated by the courts?
Yeah, they mentioned that. They see it as potentially good for the industry, sort of long term. But interestingly, they said they don't plan to roll back the changes they already made regarding late fees.
Oh, so they're sticking with their current approach.
Seems like it. They'll watch the competition, but they're not rushing to change back. Maybe a cautious stance there, too.
Okay. And finally, management's overall take on the economy. It sounded a bit mixed.
It was. They acknowledged the hard data, low unemployment, wages growing. That stuff looks okay.
Yeah.
But they heavily emphasized the uncertainty. Consumer confidence is down, small business confidence too, lots of worries about tariffs and trade policy.
Did they give specifics on the tariff concerns?
Yeah, they mentioned seeing maybe some pull forward of spending on durable goods, things like electronics, furniture, auto parts, like consumers buying now because they expect prices to go up later due to tariffs.
Which could mean weaker spending down the road if they've already bought what they need.
Exactly. That's the concern. So the speed and outcome of all this trade policy stuff, plus government action on taxes or deregulation, they see that as really key for where the economy heads next.
Okay, that makes sense. Lots of moving parts. All right, let's move into our This Is Not Financial Advice segment. Remember, we're just exploring ideas based on the call, not making recommendations.
Definitely not advice, just a thought experiment.
So, given the stronger capital base, that share buyback below book value, and this expectation of multiple Fed rate cuts in the second half of the year, those cuts might pressure margins initially, like you said, but maybe longer term, beyond 2025, they could ease things up. Here's an outrageous but plausible idea. What about going long bread financial stock, BHF, and at the same time buying some out-of-the-money call options, maybe expiring sometime in early 2026?
Okay, unpack that thinking. Long stock plus calls.
Yeah, the idea is if the Fed cuts happen as expected, and if some of this macro uncertainty starts to fade, and if bread continues to show decent credit performance and maybe even returns more capital, the stock could have significant upside, right?
Potentially, yes, if those ifs line up.
Right. So the call options give you leveraged exposure to that potential upside. If the stock really moves, the options could do very well. But your downside on the options is, limited to what you paid for them.
So leveraged bet on things turning more positive in, say, the next year and a half.
Sort of. But, and this is crucial, if unexpected economic problems hit or maybe some negative regulatory news pops up,
this whole idea could easily fall apart. The stock could go down, and those options would likely expire worthless. So high risk, potential for high reward, heavily dependent on the economy and Fed actions cooperating.
Exactly. Purely speculative, based only on what we heard in this earnings call. Definitely not financial advice.
Understood. Okay, so that wraps up our deep dive into Bread Financial's Q1 2025 earnings call. We've hit the main results, their capital moves, credit trends, strategic plays, and how they're seeing the economy.
Yeah, hopefully that gives you a solid, concise understanding of what went down on the call. We always encourage you to do your own homework, of course. Think about their capital strategy, the potential tariff impacts. Lots to consider. Thanks for tuning into TalkTickers. Join us next time for another earnings call breakdown.